When I was a schoolboy, sometimes the other kids would say, "Terrett, you're a SPAC," S-P-A-C-K. It was a derogatory term that meant a bit clumsy. Not very nice, really. But I used to say, "Don't you worry, one day I'll grow up and work on Wall Street." And so it came to pass. Today, the word SPAC is back. S-P-A-C, though, it's a very different meaning. When Richard Branson's Virgin Galactic Space Company came to market as an initial public offering in 2019, it did so as a SPAC. So did the gambling site DraftKings and the electric vehicle maker Nikola. SPACs are on the up on Wall Street, so what exactly is a SPAC? A special purpose acquisition company is a shell company, just a name, no products, no staff, maybe an empty desk and chair. A SPAC's only purpose is to list on the stock exchange, to raise money in the hope of finding and merging with a high-growth company looking to come to market. For that target company, the SPAC is a cheaper, faster, and less demanding way to go public.
Last year, there have been about 250 SPACs. They raised about $83 billion, almost as much as the traditional IPOs, which was a great success story. And this was 6 times more than 2019.
SPACs are not new. SPAC to the future, if you will. It's just that now they've become all the rage on Wall Street. Everyone's getting one, it seems. The American footballer Colin Kaepernick, famous for taking a knee during the national anthem, has started one and hopes to raise $250 million to invest in companies promoting social justice and bring them to market.
I never thought I can play for 22 years.
The former Yankee baseball player Alex Rodriguez has more than one SPAC. Before the SPAC trend, companies wishing to go public would traditionally approach an investment bank, take part in a roadshow tour around all the major investment houses to drum up business, and eventually go public once the bankers were satisfied the day and time were right. The inefficiencies of a traditional IPO mean the whole process can be a bit painful. A SPAC is far quicker to get going, but some say without the investment bank's expertise, the risks may be far greater. The commercial real estate company WeWork was about to go public using the traditional IPO route when due diligence by the investment bank in charge of things threw up some red flags. It was way overpriced and the management style of the company questionable. It was pulled, reputation saved.
The whole thing about SPAC is that it's a shell with the promise that within 2 years, we will be acquiring a company that's a disruptive, high-growth company. So you buy with that promise. If you did that with DraftKings, the vehicle that bought DraftKings, you would have been very successful. You got it for $10, $12, and it's $60 now. So that's a home run.
But in a high percentage of cases in the past few years, investors in SPACs have been disappointed. What happens is many times companies targeted by SPACs are very disruptive companies. It's early in their life cycle. They need time to develop. They need nurturing. The shares in the company end up going down, or the company stumbles. It's worth remembering, like everything else on Wall Street, you pay your money, you take your chance. John Terrett, CGTN, New York.